Let's get more on U.S. stocks. They have moved up in early trading, and our guest is zeroing in on which sectors could be undervalued here. We're joined by Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Art, great to see you. Always fun. It looks like President Trump's slowing his roll a bit on the trade and softening the rhetoric.
Yeah, certainly. I think that the post-Liberation Day, or April 2nd, when the massive sort of chaotic release of tariffs were announced and markets readjusted down by about 10% on the S&P 500, investors were waiting for the next shoe to drop, meaning, all right, is there negotiations that are possible and what will they look like? Well, shortly after that, we had that 90-day timeout to negotiate some deals, and that was the first leg up. We clawed back about 5% on the S&P 500 with that announcement, but the market was still poised for a modicum of good news. And I think that what we got last night was on two different fronts that you just highlighted at the open here. I think the fact that both the Treasury Secretary yesterday and Trump last night talked about the fact that, at 145% and 125%, those aren't tariffs. That's not a trade war. That's an embargo. That means we will not be trading with China. So they talked about the immediacy and the need to get negotiations started. And I think that's exactly what the market needed to hear. Now, we also need to hear, with all the trade negotiations that are going on, some deals be announced, whether it's a trilateral deal that redoes USMCA with both Canada and Mexico, two of our most important trade partners, or if it's one of the bilateral deals that's being talked about with Japan or India or something positive out of the Eurozone. But China is the largest of the tariff impacts, and that needs to get going. That's going to take longer, but there's certainly some places for both sides to give here. I think the other piece of the puzzle was he backed off the rhetoric on Fed Chair Jay Powell, and he still said, I'd like to see him lower rates sooner rather than later, but the whole I can't wait for him to be gone rhetoric seems to have dissipated. He probably had somebody inside the room that said, A, it's not feasible, B, it's not possible, and C, it's not a good idea. So to the extent that two of those things that were causing a great deal of uncertainty in markets over the course of the last 3 days have now slowly dissipated, you see the market's reaction now. Another 4.5% in the S&P 500 gets us all the way back to where we were the day before the April 2nd announcement of tariffs. And I think that's a positive. And then we'll just have to see when we start getting some of the economic data, how much damage has been done in the short run by the uncertainty and the lack of decision making by both investors and consumers and folks that run companies.
When you look at sectors and their performance this year, what jumps out for you? For example, do you think some sectors have been beaten up unfairly?
Yeah, I think both sides of that, Andrew. Think about it like this. So the market clinched up from the beginning of this year and got very defensive. So defensive sectors caught a very large bid. So consumer staples, for example, trading at 23 times, which is about 6 multiple turns more than their average, are likely going to be seen as expensive if, in fact, some of the fog of this trade war dissipates. Now, the other side of that is technology is the most oversold sector for some obvious reasons, and those reasons are it's the riskiest, and it largely sells things that we want versus things that we need. So I think when you get a rebound in the markets, you're going to see a larger rebound or more beta in things like the technology, consumer discretionary, and communication services. The other side of that trade likely would be you'll see some profit taking in some of those consumer staples, utilities, and healthcare, because they've been the sectors that have seen investor dollars flood into that sort of defensive piece of the market. So I think if you're going to start to see the market rally, you'll see much larger rallies in things like tech. We're starting to see that over the course of the last 2 days. I think that continues. Get a little more mean reversion in some of the overbought defensive sectors, and even some of the overbought defensive investments like gold probably has some to give back. You have gold up some 30% on a 12-month basis. Clearly, at least in the short run, probably gotten a little ahead of itself, and that'll probably sell off a little bit. And you'll certainly see a similar reaction in the Treasury curve. We're seeing yields back down to 4.3%. I think that's pretty healthy. So I think we're in a place where some of that trade that was so defensive unwinds a little bit, and some of that trade that was risk avoidance likely starts to see some sponsorship.
That's interesting. The gold bugs won't be delighted to hear you say that, but we've seen something of a recovery even in the US dollar today, and that tends to be bad for gold.
Yeah, I think gold being dollar denominated, I think the gold bugs have a lot to celebrate over the last 2 years.
Yes.
So I don't think a bit of a give back here is really going to upset the apple cart there. I certainly think if you look going back 2 years ago when we broke out of a 12-year range, gold has just exploded, right? And I think there's three things that play into that likely still continue, right? So ease of use with the ETF GLD, you've got so you don't have to buy it and store it someplace. You've got central banks that will continue to buy gold, and that is their asset class of choice to hold on their balance sheets. But just the short-term momentum here likely has to run out of steam for a bit. So I think that technically, it's a move that has literally gone parabolic over the course of a couple of months. But I think the longer-term environment for gold looks really good.
The economy, I know some investors think you shouldn't worry about it, just buy good stocks and ignore what the economic metric data says, because it's often confusing. But do you think America could go into a recession, and what would that mean for stock valuations?
Yeah, I'll tell you this. I think that the uncertainty that has surrounded certainly the first quarter of this year likely will produce GDP growth rates that are negative. So the classic and simple shorthand definition of a recession is two quarters where you have negative growth, right? 2 quarters of negative GDP. And that's physically possible. But I think that the interesting part about that, with equities being a forward pricing mechanism, we'll likely look through the first quarter GDP reports that may well be negative by 1.5%, and look at the second quarter, which could be flat or modestly negative, but close enough to that level where you can say, okay, we had 2 negative quarters of GDP. And I think equity markets will look at this and say, yeah, we know that's in the rearview mirror. We need to look at what kind of economic growth we can have in the back half of this year, especially if we settle the trade war and start thinking about the fiscal response with keeping corporate taxes where they are and a lighter regulatory touch, which will both be tailwinds for this market. So I think that you may well have this technical 2 quarters of having negative GDP growth, but I think the future probably looks brighter, since we're going to clear up a lot of uncertainty around trade and likely benefit from a couple of other new policies, which would be lower taxes and less regulation.
It is interesting, though. We have seen this move out of U.S. assets this year, relatively speaking. Apparently, emerging market stocks have now erased all their losses for the year.
Yeah, and that's not, and developed international markets have done very well. They're coming from a very low starting place. So if you look at a 3-year chart, you're clearly seeing North American outperformance for a significant period of time. This year, though, there's whether it's the currency, whether it's the fact that at the beginning of the year people are saying what hasn't performed well over the course of the last couple of years, and where are there opportunities. Both emerging markets and developed international markets have certainly done well. I would say that they always look inexpensive. So on a multiple basis, whether you're looking at developed or developing, they both look cheap, but they look cheap for a reason, and especially in some of the European markets, they just don't have a whole lot of technology. So when we look at the $5 trillion market cap companies, they're all based in America, right? So, and to the extent that they still have some of the problems that they've had, whether it's high debt levels or low demographic growth, I think that the run there may well take a pause, especially if you start to see an uptick in North American markets.
Thank you so much, Art. Always great hearing from you. Chief Market Strategist Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Let's